Welcome everybody to this first session today. We unfortunately have only 2 papers. The third presentation was cancelled due to illness, and we thought of giving every presenter and discussant a little bit more time, say 5 minutes more, and if there are more questions in the general discussion, we can also accommodate for that. We hope you will enjoy a lot the 2 presentations. The first is by Jonathan. The floor is yours.
Well, thank you for coming to this early session. Thanks, Christoph, for organizing this nice session and putting my paper in the session. So this is a joint work with my co-authors, Emre, Kathy, and Shengxing. And I'm from the Bank of Canada, so the usual disclaimer applies. In this paper, we want to talk about DeFi lending. As we know, right, so since summer 2020, the so-called DeFi summer, there's been tremendous growth, right, in terms of the scale and the scope of decentralized finance, which aims to use smart contracts to provide financial services, right, without relying on traditional intermediaries. And this graph plots the total value locked into DeFi. As we can see, it has reached its peak of 250 billion, right, US dollars earlier this year, before the the decline triggered by the Terra crash, and more recently there's a small revival. And today we will focus on one important component of DeFi called DeFi lending, which accounts for about 20% of the total value locked in DeFi. The major platforms, right, include Aave and Compound, which run mainly on Ethereum network, and also Venus running on the Binance Smart Chain. Recently, policymakers raised concern about the financial stability implications of this type of arrangement. For example, right, the deposit and lending in these platforms are quite volatile, much more volatile than typical bank loans and deposits. And in a recent BIS report also highlighted procyclicality, in the sense that the activities on this platform are highly correlated with crypto asset prices, and they argue that it could amplify the boom-bust cycle. So while policymakers concerned about financial stability implications, economic analysis is very limited, right? And that's why we try to help here. We try to help us to think about several questions. First, what's special about DeFi lending? How do these protocols, right, trade off efficiency and stability? And what are the implications for crypto price dynamics? But before I go to the formal analysis, I want to spend a few minutes to highlight some special features of DeFi lending. So in this table, I try to contrast traditional finance and DeFi along a few dimensions. First of all, in terms of regulations, right, of course, like banks in traditional finance, they are highly regulated, right? Reserve requirement, liquidity, capital requirement, also deposit insurance, all these different sorts of regulation. While in DeFi, so far there's no regulation, right? While the identity of borrowers are also quite different, right? In traditional finance, right, the bank borrowers are identified. What does it mean? It means that you can basically use you can do a credit scoring, right? You can track the history, and you can use dynamic incentive, right, to incentivize them to repay the loan. While in the DeFi environment, right, on the blockchain, everyone is more or less anonymous, right? So it's very hard to use traditional reputation-based mechanism to incentivize repayment. The available collateral is quite different too, right? In traditional finance, you have access to, government securities, corporate bonds, right? Real estate, right? All these real world assets. While In DeFi, you can only tokenized asset can be used as a collateral, right? Anything off-chain cannot be collateralized on those, right? So, and this crypto asset typically are very volatile, right? Even for Ether, right, it can lose 30% of its value within a day, right? Not to mention other even more volatile assets. And also an important difference is how the intermediary functions, right? In traditional finance, we always rely on some trusted human actor to execute financial contracts, while the whole idea of DeFi is to replace these human actors, right, by a so-called smart contract algorithm, which is pre-programmed, okay? So we think these are important features, and that generates some implication for the arrangement in DeFi lending. First of all, typically, if we look at lending platform, they are using linear non-recourse debt contracts, right? For example, in Aave platform, if a borrower tries to borrow a loan, say a USDT tether, right, from this lending pool, they use, as I mentioned, you can only use a tokenized asset, a crypto asset. This is very volatile, so over-collateralization is required, right? So that means a haircut is going to be a very important parameter in controlling risk in this environment. And then, as I mentioned, right, lenders and borrowers, they interact through this smart contract, right? And this contract has to be pre-programmed, deterministic, right? So it's set as a contract, and that means all the terms, including the haircut and the interest rate functions, are all pre-programmed, right? You cannot adjust in real time. And updating this contract is also require a lengthy voting process because of decentralized governance, right? It's not controlled by a human being. Finally, there's also different reasons that there are informational frictions on this platform. Let me name a few. First of all, when the lender and borrower interact, right, in the lending platform, the borrower typically can choose to pledge one of many available crypto assets as a collateral. In the case of Aave, you can choose a set of around 20 different crypto assets with different characteristics. In cream finance, for example, there's 100 different crypto assets. And while this is the case, the lender cannot control which type of asset they pledge and cannot easily monitor. As a result, this is very much like a mortgage-backed security or asset-backed security, right? You have, the loan is kind of backed by a kind of relatively opaque set of assets that generate some kind of asymmetry in information between the two sides. But this is not the only reason, right? Given the collateral set, there's also reason to believe that, right, the borrower and lender, they have asymmetric incentives to acquire information. So there are many different crypto assets, right? There are over 1,000. They want to borrow one type of crypto, in this case a tether, and using Ethereum, for example, as Ether as the collateral. And this is typically, that would be the trade that they do, right? They pledge one type of crypto and then borrow a stable coin. That's typically, and then there are many different reasons why they want to do it, right? Maybe they want to do a leverage purchase of the collateral asset, or sometimes they just want to get the governance right in the voting so that they want to borrow a particular crypto asset. Maybe they want to do arbitrage, right? So it's not very well known because, you know, on the blockchain, it's hard to trace the activities. And just let me continue, right, to quickly talk about different informational friction. One is about asymmetric incentives to acquire information, right? Think about a borrower. You know exactly what type of collateral you pledge, so you have incentive to learn about, you know, that return of a particular collateral, while the lender, right, does not know what you are, you know, lending against, so it's hard for the lender, right, to spend effort, right, have lower incentive to spend effort in learning those, the values of all these possible collateral values. And more recently, they also start to lend, right, against NFTs and real-world assets, meaning like mortgage loans. So these are of course, also subject to even more opaque. And these are all about common value, but also private value, right? The borrower may have private valuation of a particular crypto, which of course is not observable by the lenders, but the private valuation is going to affect the incentive to repay a loan or not, right? So these are different reasons. But ultimately, in our model, we want to capture these three features, right? Linear, non-recursive stack contract, rigid terms, and some kind of informational friction. So these are the building elements of the model. And what I want to do, given the time limit, I want to do two things. First of all, I want to show you a simple static model, but to highlight the main mechanism in the model, generating a feedback loop in terms of price and liquidity. And then I will quickly generalize in a dynamic model to show how this feedback loop will lead to multiplicity, sentiment-driven cycles, and why the rigidity of the contract is crucial in driving this type of implications. Okay? Of course, there's a young but fast-growing literature, and many of you are involved in this literature. Most of them focus on either decentralized exchanges or stable coins. And what's special about this paper is focusing on lending protocols. We try to build a dynamic model and understand this lending protocol and relationship with crypto pricing. Okay, if there's no question, I will go to the simple model. The purpose is to highlight the main mechanism. Think about a world with two agents, a borrower and lender. Borrower has a risky asset, a crypto asset. The lender has some funding, right? That's gains from trade because the borrower, the marginal valuation of funding of the borrower is Z, which is higher than the lender's marginal valuation, which is normalized to 1. So that's gains from trade. The friction, the fundamental friction in this world is limited commitment, right? Agents cannot commit to future actions. What does it mean? It means that if I'm a borrower, I cannot borrow an unsecured loan because I cannot commit to repay you in future. If I'm a borrower, I also may not want to borrow a secured loan, a collateralized loan directly from the lender because the lender may not be able to commit to return the collateral to me. Right? They may potentially rely on an intermediary but as a custody, right? But they also need to worry about the incentive of the custody. So that's why maybe a smart contract can help, right? Basically, with a smart contract, you lock the collateral into the smart contract, and the collateral will not be released until the borrower's repayment is received. Right? If the repayment is not received, then the collateral will be liquidated and use the funding to repay the lender. And we don't need to worry about the smart contract incentive because it's just right, a program. So this is the main idea. And here we model crypto as an asset that generates a dividend flow, right, delta each period. And then after the dividend, right, the price is given by phi. In the static model, phi is, we can take it as exogenous. In a dynamic model, it will be determined endogenously. So, and then think about a smart contract, which specifies two terms, Q and D. Again, for now, take them as exogenous. So, meaning that if you hold an asset, you can borrow up to Q unit of, so I will talk about Q and D. Q is if you pledge an asset, how much you can borrow. D is how much you need to repay. So D over Q is the implicit interest rate, right? So when the loan matures, right, the borrower can either choose to repay the loan, the D, or to default. If they default, they will lose the value of the collateral, the dividend value and resale value. Right from the lender's point of view, the expected return is basically the minimum of the two. Right? If the guy repay, you get D. If the guy default, you get the value of the asset. Okay? Now, the asset is risky and there's informational frictions. Right? In this setting, we model in this particular way. The borrower can observe a quality shock, right, before they borrow the loan. The quality can be high or low. With probability 1 minus lambda is good quality asset. In that case, as described, you get the delta, and the asset will continue with probability 1 next period. But with probability lambda, it is a low quality asset. okay? You will not get the dividend today. On top of that, the asset can crash, right? So with some probability, SL drawing from a distribution. So here, lambda is capturing the quality of the asset, right? How likely you get this shock, and then SL is capturing the persistence of this shock. So let me show you the timeline. So first of all, given the contract terms, the borrower learned this signal, and after that, decide whether or not to borrow and borrow how much. At the end of the period, all the information is revealed, loan is repaid or default, and the asset is priced. Okay. So the key problem here is the informational friction will control who and how much will borrow from the pool, and that leads to adverse selection problem. Think about a setting, right? We have two borrowers, right, with high or low type, depending on the signal. They will choose to how much asset to pledge, right? This A is how much they pledge. They know that by borrowing, they will get this return, Z times Q. They need to repay D. But then they have an option to default, right? We call it the default option. Basically, whenever the value of the asset is lower than the that face value, you want to default, right? So first observation is that the low type, given that the value of the asset is lower, the low type will have a higher default option value, right? Because the asset is lower, it's less costly for them to default. So that means also that the low type will have high incentive to borrow. So that's bad for the pool, right? The low type has high incentive to borrow than the high type. That generates adverse selection problem. As in any adverse selection problem, we care about whether or not we have a pooling outcome where both types borrow or a separating outcome. Only the bad type borrows, right? And when both types borrow in a pooling outcome, basically the high type is cross-subsidizing the low type, right? Because they are under the same terms of trade, right? But then the high type is basically subsidizing the low type in terms of getting this default option value. This is shown, this default option value is given by this graph, where the vertical line is capturing the debt face value, and the blue is the distribution, capturing the realization of the value of the asset. So whenever the value of asset is below the debt face value, you want to default, right? So this red region is capturing this default option value, right? The larger the default option value, the larger incentive for the low type to default, and that means the high type will need to subsidize more the low type, and that means it's harder to support a pooling outcome when this area is big. So in order to support a pooling outcome, we need to think about how to make this red region smaller, right? So that, so that the cross-subsidization is smaller. So there are two factors influencing this default option value. One is the D, right? If you make the loan size smaller, so D drops, then the low type, right? They don't default just for a small loan and give up the asset. So reducing the loan size, right? The D, that limit will help, right, to support a pooling outcome. Another thing is that asset price matters too, right? When your asset price goes up, the distribution of the value of asset moves to the right. So this default option value also drops. Why? Because even for the bad type, now the asset has a higher value. I don't want to default and give up this asset easily, right? So this is interesting because it tells you that when asset price is high, it helps to mitigate adverse selection, support a pooling outcome. In equilibrium, when you have a pooling outcome, the lender knows that, well, the high types are also borrowing, then the lender would be willing to lend more, right? So this is the connection. Higher asset price helps to mitigate adverse selection and helps to stimulate more lending. Okay, so this is one side of the loop. How about what determines the asset price? In a dynamic setting, asset price is just continuation value, right? Discounted continuation value. So next period, right, you can receive two types of return. The fundamental return is that expected dividend, expected resale value. This is fundamental value. While more importantly, right, here is the collateral value. Next period, you can use the this asset as a collateral to borrow loans. And how much you can borrow depends on Q. So if you expect that you can borrow a lot, then the collateral value will go up, so that today the asset price will be higher. That completes the loop. Okay? So let me repeat. High asset price, mitigate adverse selection, induce more loan, larger loan size. When the loan size is higher, the collateral value goes up. As a result, it will in turn increase the asset price. That generates the feedback loop. And this is the main mechanism in the paper. So in the remaining time, what I will do is to quickly show the dynamic setting and show you how this feedback loop will generate 3 interesting results. So the dynamic setting is basically just repeating the static model indefinitely with 2 changes. One is that, well, maybe borrowers sometimes may not get private information, right? We can say that, well, maybe you have private information in particular period with probability chi. This is IID shock, just a parameter to help us to control the information frictions. But more importantly, right, we haven't endogenized the contract terms, right? What is the debt limit? In reality, that limit follows a haircut rule in the contract, right? The smart contract says that you can borrow up to a fraction of the value of the asset, and the fraction is given by a parameter, haircut parameter. And importantly, this haircut parameter is rigid, it's pre-programmed, and it does not change dynamically, right? So this haircut parameter will be important parameter to capture the debt limit, right? And then this is capturing the rigidity of the haircut parameter will represent the rigidity of the contract. Okay, so given that, we're going through some analysis. I will skip this. But the key result is that, well, we still get the separating equilibrium and the pooling equilibrium. Separating equilibrium is the case where only the low type borrows, right? The high type does not borrow. As a result, the loan size is smaller. The pooling equilibrium is when both types borrow and the loan size will be larger, that we talked about earlier. Now, I'm going to show you 3 important results. First is that multiplicity. We can show that a pooling and separating equilibrium can coexist under certain conditions, right? So in particular, what we need is that information, that we need some private information. This is important for generating the multiplicity. And we need a haircut, cannot be too high, right? Because the key thing is that you want that kind of the contract, in a paper we define, the contract needs to be informationally sensitive. Then you can support a multiplicity. And the whole idea of multiplicity is self-fulfilling. If you expect that tomorrow lending is going to be active, then today the asset has high value. If today the asset has high value, it can mitigate adverse selection and support more lending today, right? So that's support the pooling equilibrium. In contrast, if you have pessimistic belief, then you will get a separating equilibrium. And these 2 equilibria coexist, right? And this is driven by strategic complementarity that we are familiar with. And here is dynamic in nature because the current period agent, right, cares about the future period agent's decision. So this is dynamic strategic complementarity. Okay, so this multiplicity. Once we get multiplicity, we can also generate what we call sentiment cycles, right? So here, think about a setting where fundamental variables are fixed. So the environment does not change, but there are some sunspot variables that can fluctuate over time. So for example, here is a particular realization path of this sunspot variable, which is non-fundamental. But people use this sunspot to coordinate their belief. As a result, in equilibrium, asset price and lending activities are going to fluctuate, subject to sudden decline and jumps. More importantly, they co-move. Asset price and lending activity co-move together, capturing the post-cyclicality mentioned in the BIS report. And the third result, before I finish the talk, is that all this multiplicity sentiment cycle are related to the rigidity of the contract. And so remember, haircut H is constant. We assume it's rigid, right, as in the real world. What if, for some reason, the lending platform can adjust it in real time? So we show that if you can set a what we call optimal state-dependent debt limit, right, the haircut, to adjust the debt limit, indeed, first of all, you can increase the surplus, so efficiency goes up. More importantly, you also eliminate multiplicity and the sentiment cycle, so it's also more stable, right? So the idea is very simple. Basically, the optimal state-dependent debt limit is such that if you know that the sentiment is bad, you want to set a tight debt limit so that you can support a pooling outcome. When the sentiment is good, you want to take advantage to set a relaxed limit so that increase efficiency, right? So when you can do that, then you can improve both efficiency and stability, right? So that's why flexibility in contract is important. However, it can be very difficult to implement in real-world smart contracts. Why? For several reasons. First of all, this is not a simple contract. Even in a simple example, the contract can be quite non-linear. So you need to program it. Typically, the smart contract in lending pool are pretty simple. You need to have a quite non-linear contract. And more importantly, this contract depends on certain variable, deep parameters in the economy. And some of these parameters may not be on-chain, right? As we know, right, only on-chain information, right, can be fit into smart contract, right? Otherwise, we need a good oracle. So that can also be difficult. Potentially, you can update the contract, right, in real time, but then that can also be challenging because of decentralized governance. So basically, the conclusion here is that if we look at this decentralized environment to support this dynamic contract, which rely on basically over-collateralization, can be challenging because you need to have a very flexible contract to achieve stability and efficiency. And ultimately, maybe this type of lending pool, we need to think about if it's optimal to reduce the degree of decentralization. Maybe they can, hire a risk manager to handle the haircut for them dynamically, but that potentially that's against the spirit of decentralized finance.
All right, so thank you, Christophe, for inviting me to discuss this very interesting paper. So I'm going to do two things. I'm going to summarize the model, at least to focus on what I think is the most important part, and then I'll have a couple of comments. The comments will be mostly about where I think the paper could improve in terms of matching the actual setting or application that it's looking at, so DeFi, crypto lending platforms. Okay, so summary of the model. So we have 3 agents. One agent is a decentralized lender, or it's actually multiple agents. These are decentralized lenders. These have cash, which you should think about stablecoins because these are on the blockchain, and they are willing to lend those. Then on the other side, you have the borrowers. The borrowers, they have some crypto assets that they are willing to use as collateral, and they want to borrow because they have a project to finance. So there is a positive NPV value in that investment. And then in the paper, it was not that much the presentation, but you have some intermediaries that are setting the level of the interest rates on these decentralized loans, and they are setting up some fees for making that task. And then everything is decentralized, so if you have a bunch of lenders on one side, a bunch of borrowers on the other side, and everyone borrows, put everything in the same pool and takes it from the pool. So that's the decentralization. What's important here is that decentralization implies that there is free entry, so that the profit in equilibrium should be 0. And that means that the free entry is going to give us a quantity equation for the quantities of funds that are lent at any point in time. And so the main friction in the model is that crypto collaterals have time-varying private information quality. So the world here is that there are like different cryptocurrencies. Everybody has different set of cryptocurrencies, and then you have private information. You know better than the other side what's the real value of your cryptocurrency. So that's going to trigger a classical asymmetry of information problem. Okay, so more precisely, with probability lambda, then the cryptocurrency that the borrower has is a good cryptocurrency, which means that it's paying some dividend delta, and you know for sure that it's going to survive for the next period. With probability 1 minus lambda, then it's a bad cryptocurrency, and in that case, it's not going to pay any dividends for that particular period. And also, on top of that, it's only going to survive to the next period with a given probability. That given probability is SL, and SL is itself stochastic. Actually, one of my questions I'm front-loading, I wasn't sure exactly why you need SL to be stochastic here. It might be generating some option, some convexity in the option value, but it's not clear that you really need that. Okay, so what's going on with the asymmetry of information? Well, that means that lenders cannot discriminate between borrowers with good or bad collateral. So that means that, as in traditional setting, two equilibrias are possible. You can have like either a pooling equilibrium where everyone's going to borrow, and the terms of lending are going to be the same for everyone in that case. Or you have a separating equilibrium in which only the bad collateral agents are going to borrow. And the key result, for me, key result of the paper is that for some parameters, both equilibria are going to coexist at the same time. And that's going to create some fragility because you'll be able to move between equilibria by sunspots or coordination. So, okay, so why is that? Well, that's because you have this dynamic feedback between the crypto collateral price and adverse selection. So that's the figure that Jonathan showed us earlier. When the asset price of the collateral is high, that means that adverse selection is going to be low. Because adverse selection is low, it means that you have a lot of high quantity of loans, and high quantity of loans is going to mean higher collateral value, which means that in the first place, the high asset price valuation can be sustained. But then, of course, it can also work in reverse. It can be that you actually have a low asset valuation, which means that adverse selection, that setting is actually high, which means that you have low quantities, which means the collateral value is actually low. So like self-fulfilling prophecy or fixed points that's going to hold. Okay, so let me move to the comments. The first comment is really about the match between the model assumption and the application. And so when I read the paper, I think it has all of the elements that you think about when you want to model a crypto lending platform. But maybe then if you go in the fine details, I think some of the match could be better. And so, for instance, I think about this model as being like a perfect model to, if you were to model a fintech buyer in the housing market. Because it's really a model about private information about your own asset, and everyone has private information about its own asset. Whereas you think there are like the number of cryptocurrencies that are really used as collateral in platforms, not that plenty, and that information, there's no real reason for me for the borrower to have that much more information than the lender or the platform by itself. That doesn't mean that there isn't any asymmetry of information in the real world in that setting, but I think the asymmetry of information comes from a different setting. It comes because typically the way the platform values the collateral assets, it's done through oracles. And these oracles are kind of slow moving. So it takes some time when there is a large movement in price, it's going to take a little bit of time for the oracle to update, which means that if somebody can take some of the collateral out of the pool at a given price, and that price is not updated, that means that you can actually make a profitable arbitrage trade. So when you have a lot of volatility, that's a problem. That's a form of asymmetry of information, but I wasn't sure exactly how that relates to what you have in your setting. So I think it would be useful to explain a bit more and get to there. Just to finish on that point, there's this very interesting piece on exactly that mechanism by Adams and Ebert at the New York Fed, which basically argue that exact mechanism is the reason why the stablecoin Titan completely failed. Because there is this dynamic feedback, which is that it's actually, in order to realize the arbitrage, you need to get to withdraw some of the stablecoin. That's going to push price even further down, which means that there's a new arbitrage appearing, so more people are going to withdraw. So it's almost a classical run through this asymmetry of information. I was wondering if your model could capture something like that. Okay, my second comment, I would like to zoom a little bit more on basically that part, the first part actually that you described in the presentation. So the link between asset price and adverse selection. And at the beginning I was a little bit surprised because that seems to really come from the asymmetry, the assumption that you have an asymmetry in the dividends yields between the two different assets. And because we are in a setting where usually we don't think about cryptocurrency as paying dividend, I was a little bit surprised. It took me a bit of time to understand where that's coming from. I think that's fine, but I think it would be useful to explain a bit more. So, okay, so basically the key equation for this relationship is this equation over here where you have the information sensitivity, which is the expectation of the return in the low state divided by the expectation of the return in the high state. And that's how you are with respect to this threshold. If you are above, then you are in a pooling equilibrium. If you're below, then you're in a separating equilibrium. So that's basically the shift thing. Okay, so what's important for this relationship that I described is that this depends on phi here. But then if you look at the definition of this ratio, which is what we have in this equation, we see that actually if you put the dividend yields to 0 here, or actually if you would put the dividend yield to the same dividend yield as the other asset, then the phi here would completely cancel out. And so, at the beginning I didn't really get why, but basically the idea is that if you have an homogeneous increase in asset price, that's not going to do anything because it's not going to change the return, the return ratio, so not going to change the information sensitivity. So what you actually need is an in-period asymmetry that affects this information sensitivity. I think that's why in the model you need this dividend to take place. I think another way you could do the same thing is basically looking at asset price independently of two assets that you can use within your pool. And I think that should be fine. It might introduce a little bit more complexity going beyond, but I think that might actually be manageable. So I would prefer that, especially because it might raise concern that somebody asked a question on that the cryptos don't pay dividends. Okay, and my last point is that typically in this type of model, you think that you are going to use, or you're going to use the risky project itself as a collateral. And here it's something a little bit different. What you do is that you have your risky project on the side, but you're using some of your cryptocurrency that you've been holding from the beginning as collateral. But then that begs the question, why don't you sell the cryptocurrency in the first place? Like, what's the value for you to keeping the cryptocurrency and doing it as a loan rather than selling it, financing the project, and then if you want, you can buy back the crypto at the end? Like, what's the additional benefit? So I think it should come like either there is a friction or like a reason for that to be, or maybe it would be also interesting to think about what if people were using this loan in order to leverage, in order to increase their leverage in the cryptocurrency project. Instead of investing in a real project, actually leveraging their position in cryptocurrency, which I think is actually what most people are doing. And I guess that's actually going to amplify the fragility that you observe. So I think this would be an interesting setting. And so that was my last comment. So I think it's very thorough. I think it's already very well written, very British paper. I think it's on a topical question that needs more theory. There's basically nothing on that. And it's also not trivial at all to understand what's going on with this platform. So I really commend the authors for that reason. I think the paper will still benefit from like making the assumption a little bit closer to the setting that you want to study, and also be a little bit more clearer on what assumption is driving what result. I think that was in the draft I read wasn't always exactly clear.
Okay, well, thank you, and I appreciate the opportunity to present this work to you today. So I recently joined the BIS, so I guess a disclaimer that these are my views. And this is joint with Jiaheng of MIT and Haoxiang, who is now at the SEC. So there's a slight change in the title, but I'll mention that. So it's now the case for convenience got added in front. So how does CBDC design choices impact monetary policy pass-through? The change of title is really just an artifact that we've been working on this paper for about a year and a half. And it's essentially was a collection of results for a long period of time. And now we've realized that there's a pretty clear message that comes from looking at these results in the aggregate. And so I'll try to convince you that what this analysis does is really show that when we're thinking about CBDC design, which is, I think, really where we are, by the way, in this debate. We talked for a long time over the last few years about, should we have a CBDC? What form should it take? What are the implications for monetary policy and financial stability? And as banks get closer and closer to think about actually launching CBDCs, then one has to take seriously these questions about design. And I'm going to make the case that in thinking about the design, building in convenience, and I'll explain what that means, ends up being, I think, one of the best ways to make the CBDC effective. So I start off with this quote, which I think I've been using since the day it was made. So this is by Ben Broadbent, the deputy governor, one of the deputy governors of the Bank of England. And he said back in 2016, if all CBDC does was substitute for cash, if it bore no interest and came without any of the extra services we get with bank accounts, people would probably still want to keep all their money in commercial banks. And essentially what he was responding to was this idea that when people first started thinking seriously about CBDC, there was these fears, disintermediation of the banks. And he was trying to essentially say that, well, look, if we built this thing in a very pared down way, it would just become a replacement for cash. It wouldn't disintermediate banks. And it's kind of interesting because the way that people are thinking about CBDC today has really evolved from that point, where they're starting to think about it more in terms of something that could be better than cash, right? So not just a replacement for cash, but something that has properties that are better than cash. And there's this movement from it being sort of non-disruptive to being more effective. And so that's what I'm going to talk about here today. And in particular, I want to just mention that the way we're going to think about that CBDC can improve upon cash is both in terms of the store value function and medium of exchange aspects. Okay. And so the other thing I wanted to do just to get started is that politicians, of course, weighs in, and regulators and policymakers weigh in on what CBDC should do. And so I've listed here two opinions that have been posted. One is a Banking for All Act in the U.S. This was by Maxine Waters of the House Committee on Financial Services and by Sherrod Brown, the Senate Banking Committee. And all I really want to do to highlight this is that, well, there's two things that are interesting about these. One is that how prescriptive they are. So especially the Banking for All Act is there's about 9 requirements that it lists. But I'm picking out on these two because they focus on the two things that I care about here, which is one is the idea that it should be interest-bearing, and then the other is this idea that it should have convenience features, okay? How accessible it is, automatic bill pay, customer services, and things like that. This is what I mean by convenience features. And both of these things are also included in the ECB Digital Euro report, both the idea about monetary policy and the idea that it could be interest-bearing, and also the idea about it including convenience, usability, convenience, speed, and so on. Okay. So what's this paper going to do? So what this paper does is we consider 2 key design features that relate to these 2 properties, the store of value and the medium of exchange. So the first idea is that it's going to be interest-bearing, and we're going to show that in the model the fact that it's interest-bearing is going to put a lower bound on the deposit rates that interest pay on the banks pay on deposits. But we're also going to argue that this is an effective way to raise deposit rates, but it's going to lead to a wider divergence of market share. So one of the key features of this model is that we consider heterogeneous banks. So we consider banks of different sizes. And this, I think, is a very important feature to have in a model that's evaluating CBDCs. I had a discussion with a policymaker once, and I asked them, if they talked to banks about CBDC, and what the response was, what banks are thinking about this. And one of the reasons I asked this question is because I thought I wanted to hear if different banks said different things. And so, when this paper was started, I just left the Bank of Canada, where I visited for a year, and so I was thinking in that context. And so in Canada, there's a few very large banks and a bunch of very small banks. And so if you think about CBDC and what banks' opinion is of a CBDC, then one would imagine that the Royal Bank, which is the largest bank, would have a very different opinion than Laurentian Bank, which is a very small bank, because the CBDC can impact these banks differently. So we wanted to build in this idea of heterogeneity in terms of banks, and in fact, this is going to drive all the results. But it also means that when we're thinking about the impact and the impacts of design, we're thinking about not only ideas like how does this affect deposits, how does this affect interest rates, we're thinking about how this affects banks differentially. So what it does to the market structure. Okay, does it lead to a divergence or a convergence of shares in the market, in the deposit market, in the lending market? We're going to think about those implications as well as the overall implications. Okay. So we're going to show that interest-bearing CBDC is an effective way to raise deposit rates, but as I just said, it's going to lead to a wider divergence of market shares. And we're also going to show that it can reduce the responsiveness of deposit rates to changes in the IOER rate. So by the way, the monetary policy pass-through that we're talking about in this paper is the impact of changes in interest on reserves, which is the main policy rate in the United States, on deposit rates. That's the pass-through that we're talking about. And when I talk about changing the responsiveness, I'm saying that if you look, it's like a cross partial, right? So you have the derivative of interest rate with respect to IOER, and then how does that change when you raise the interest rate or alternatively raise the convenience value? Okay. Convenience value, on the other hand, is an interesting variable. So it can also raise interest rates, but it also has this nice feature that it levels the playing field. And this is what I was trying to get at when I mentioned the idea of really focusing on banks of different sizes. So put very simply, having a CBDC allows Laurentian Bank to offer services that are very comparable to the services that Royal Bank offers on one dimension. It brings Laurentian Bank in some ways up to the level of Royal Bank. And that has very interesting implications in terms of how they compete in deposit and lending markets. So if the CBDC convenience value is high enough, then this is going to result in an increase in deposit rates. So it's going to meet the core objective, trying to bring deposit rates closer to IOER. But it's going to cause market shares to converge rather than diverge, okay, which one could argue is a desirable property. And then, in fact, it also increases the responsiveness of deposit rates to changes in IOER. Okay. Those are the, just by comparing those two bullet points, that's really the case for convenience. Okay. Another thing that we do in this paper, which I think is important because I just haven't seen it very much in the monetary policy or the monetary theory literature, is thinking about the long-run framework. So in the United States, the long-run framework is a term that's used to describe this world in which excess reserves are in the trillions. So if before the financial crisis, the excess reserves in the United States were like 0.5 billion, and then after the financial crisis, they were 2.7 trillion, and now they're even higher than that. So we live in this world where the idea of conducting open market operations, to find, to sort of target an interest rate, a federal funds market interest rate, is not what's done. Rather, the interest rate, the federal funds rate, is really determined by setting this floor rate, interest on reserves. So we need a model that's going to incorporate that environment if we're going to understand how CBDC works. And also, I think that this also is another, important part of this paper is that all models are simplifications of reality. But I think if a CBDC model should be tailored to a specific economy, or at least the specific features of that economy, in order for it to be somewhat prescriptive of how a CBDC might impact that economy. So this model is somewhat tailored to the U.S. And so I'm going to talk a little bit about the model that we use, which independent of the CBDC, I think is a useful model for thinking about the long-run framework. And that model builds on previous work by Antoine Martin, Jamie McAndrews, and David Ski, and also a paper by David Andolfato. And the key features of these models is that reserves are abundant, and lending is determined by the opportunity cost of funds. Banks don't need to attract deposits to make loans. They do, but they have enough reserves. They're not going to be bound by a reserve requirement. And so a loan is made if its return exceeds the marginal opportunity cost of the funds. Okay, and so the difference in our model between these previous models is that deposits generated by the loans may be retained. So the opportunity cost of lending is related to deposit market share and differs across banks. That's a key point because that drives why large banks and small banks make different decisions in deposit lending markets, and I'll explain that clearly in a minute. Okay, so just a quick nod to the literature. So there are, of course, many papers on CBDC. As I said, our paper is focusing specifically on features of the U.S. market and trying to take the design aspect seriously. And like I said, the results pivot greatly on the idea that we're considering the impacts on banks of different sizes within the market. Okay, so now let me get into some details of the model. So there's a large bank and there's a small bank. Banks' assets are reserves, so we call them XL and XS, and we assume that the total amount of reserves is very large. So for example, there's no binding reserve requirement. And we can start off just by thinking about the bank as being an arrow bank, so it has reserves and deposits, so it has a balanced balance sheet, and then the central bank pays interest on reserves, which we denote by F, so that's the policy rate. And then the banks set their deposit rates, so RL for the large bank and RS for the small bank. And bank deposits can also have convenience. So what we assume is that there's a large bank and a small bank, and the large bank, for a variety of reasons, size, the amount of money it spends on IT, a better payment app, more ATMs, a variety of reasons, the large bank offers more payment convenience than the small bank. And so, there's just a picture of like lots of apps. And so we normalize the small bank's payment convenience to 0. That's inconsequential. And then the large bank convenience is a parameter delta, which it doesn't have an I on it here, but delta is individual. So individual depositors in the market, they get a draw from a distribution G, which tells them how much they appreciate the convenience value of having deposits at the large bank with all the extra services that the large bank deposit provides over the small bank. Okay? So that's a key feature of the model. Now, in this presentation, I'm going to just basically show you pictures and focus on the case where G is uniform. It's just a uniform distribution. But in the paper, it's not. In the paper, there's a somewhat technical-looking assumption on G, but basically it just makes sure that the G distribution is such that there's not too much weight on low values and not too much weight on high values, because you want the large bank to have an advantage, but not too big of an advantage. Okay, so that you get essentially interior solutions. Okay. Another assumption is that the way we've modeled this is that the CBDC app, okay, sort of will be common to both banks. So when it produces a common convenience value V, so there's, the idea is that the features that the CBDC add are equally liked by all, okay, and they generate a value V, and that app can be accessed regardless of whether or not you have a small bank account or a large bank account. So by the way, I should emphasize that we're thinking about a world where the CBDC would be implemented through the banks. All right, so this is the most natural and likely scenario. Banks are consumer facing, they do KYC and AML activities, and so the idea would be that at the Royal Bank you'd have your savings account, your checking account, and your CBDC account. Okay, and so the idea is that if you regardless of whether or not you're at the large bank or you're at the small bank, you could always access this. If in the world where the CBDC has been launched, you can use that app. So technically what the CBDC ends up doing is it ends up putting a floor on the convenience value. So it raises the small bank's convenience from 0 to V, and then V is a parameter choice. And it also puts a lower bound on the large bank's convenience. So the convenience, everybody gets this individual draw, okay, from this G distribution, say uniform on 0 to say V some upper bound, but everybody gets at least V. Okay, so if you get a large draw for the large bank, you like it better than V, but at the very worst, you get V at the large bank and you get V at the small bank. Okay, that's the model. The CBDC also pays some interest rate S, which is also, of course, a choice parameter. Sure, question?
I don't think I fully understand what you're trying to capture with the CBDC.
Yeah.
So what's the difference between having a deposit at a bank and having a CBDC account at the bank?
So there's not a whole lot of difference. The idea is that and in fact, the assumption is you can move seamlessly across those accounts. But what they do is they essentially change the terms and the convenience that you get. So the CBDC, first of all, it's going to put a lower bound on the interest rate. So let's say the CBDC account pays interest rate S. Okay, well your bank can't pay you less than S, or you would just hold all your money in the CBDC account. Okay, so the presence of the CBDC account, first of all, it puts a lower bound on the interest rate at both banks. That's number one. Okay. The second thing that the CBDC does is it's potentially more convenient. The app, transacting in CBDC can be more convenient than transacting in the regular commercial bank money. No, the app features can be different. The money can be available on different platforms. There's all kinds of reasons why the convenience might be different for the types of money.
So I'm buying on Amazon.
Yeah.
And I have my Visa credit card. Okay, and I use it. And I also have this CBDC account at the bank. And it's linked to, I just don't understand what this difference in
Yeah.
convenience payment is meant to represent.
It's meant to represent. So, for example, there are going to be some applications that are like you say, where it's no different. Okay, but there may be other types of services that are attached to the CBDC, like automatic bill pay or who knows what, that might not necessarily be attached to.
I'm just looking for an example of a service that would be neutral in CBDC, so I can get a sense of what they're on.
Yeah, sure.
Because they were to accept the meeting, for example.
What's that?
Accept
Yeah,
the meeting.
yeah.
So it's a legal tender, so everyone, will accept it because it's a legal tender. And even now, there are some costs. So these costs will be minimized, for example, because it's a legal tender. So you know that the app of the CBDC, you'll be able to use it everywhere, like cash.
Yeah.
For example, with payment cards, there are fees, and so some, it is advertised and so on, but you might not be able to use it. Or you'll be able to use it even offline. So somewhere that internet doesn't get there, okay, there will be some technical solutions so that you can use it anywhere. So acceptability is one of these. And the other point, for example, is time, okay? So I want to transfer you some money, okay? So there are possibilities to do that, clearly. But with the CBDC, you'll be able to do it within seconds for free, like cash, like I hand you the bill.
Yeah.
So in that sense, it's providing a lower. In that sense, I understand.
No, that's exactly right. Those are all good examples, or it could be other. I mean, if you just look at the list of, those are great examples. So it could be accessible 24/7. It could have faster payment services. It could have more physical on-off ability in terms of having more ATMs. There's all kinds of possibilities, but that's what's listed. If you look at what the Bank Act authorizes or dictates, it's that you basically increase the convenience values of these accounts. But I'm going to leave that point for now and move on. Yeah. Sure.
I actually disagree with you that this system does create lower bound on the interest rate, because it looks like there are two variables that enter into the function of
Yeah, so
And I would choose large bank, which offers me better convenience, but pays also
So-
less rate. So why
because we assume that you can transfer the money seamlessly across the accounts. So you're going to hold it in the account that gives you the best interest rate, and you're going to spend it in whichever account, wherever it's more convenient.
But why, if you say if there is a huge difference between convenience of large bank versus convenience of
Because you can hold it in whichever account you want, and you can transfer it seamlessly across the accounts within a bank.
I don't want to hold it in a small bank because that's government.
No, that's a decision. So the consumer is ultimately going to decide whether or not they want to deposit in the large bank or the small bank based on this choice.
Yeah, I value convenience much more than
Yeah.
then I will put it in the large bank
Exactly.
and I will get lower interest rate.
Yes.
So there is no lower bound.
That lower rate you get will have to be at least S. S is a lower bound on the rate that both banks charge, but the two banks can charge different rates. What will happen in the model is the rate that the small bank will offer will have to be larger than the rate that the large bank offers, because they have to compensate for offering less convenience. But both of the rates must be at least as high as S. So S, because S is the lower bound on the rates, because the money is, because within either bank you can seamlessly transfer your funds across accounts within a bank.
There's a basic reason why we're struggling with this.
Yeah.
Is that bank deposit money could be as convenient as CBDC, but not by maximum.
Of course it could be, but we're...
If the banks invested in developing.
Yeah, so let me just say this, try to say this one more time. So within a bank, you have say the small bank, you have two accounts. You have your regular deposit account and you have your CBDC account. This is the way that it's being proposed. Okay? The CBDC account offers you some convenience. Okay? And both accounts will offer you interest, although those are endogenously determined. The bank's interest rate is endogenously determined, and the CBDC rate is a policy rate. Okay. First thing, the rate that the bank offers you has to be at least as large as S, because you can just keep all your money in the CBDC account. Okay, because that gives you to get that interest. Okay. And then when you go to spend the money, you'll spend it in whichever way offers the more convenience. Okay? And so in the small bank case, could also be the CBDC because it offers the convenience value. What's that?
The model is extremely clear. It's not clear that it's unjustified.
Yeah, I don't know. Okay, I think it is. I don't see why that couldn't be the structure.
You haven't persuaded the whole audience to do it.
Okay. Okay, so the timeline. So, what part isn't clear?
Well, ultimately, it's a coordination problem. The technology is such that conventional bank transaction accounts could be just as good as anything conceived with the CBDC.
Absolutely.
Yeah. So the question is, why haven't banks got together? Is it some competition problem, some coordination problem? And what's the underlying economics problem that the CBDC is solving? So I would say it's a coordination problem.
Okay, but I think that's just a much bigger problem. I'm simply postulating that the central bank, in offering a payment app, could potentially offer a payment app that offers more features, more convenience than the Bank of Laurentian, which is a Laurentian bank, which is a very, very small bank with a limited IT budget. And if you actually look physically at the apps that are offered by different PSPs, they differ greatly in terms of what the opportunities are. So whether or not this is sort of some long-run equilibrium, I guess that's a different story. But certainly if we look at the market today, there's the potential to come in with a CBDC that offers more convenience features than are currently existed by some existing platforms. Yeah, okay. So the timeline. So there's a unit mass of agents that play, so the agents in this model sort of play multiple roles. And so first of all, at time zero, banks are going to set deposit rates. The central bank is going to set its policy rate, so it's going to set IOER rate F, it's going to set its interest rate S, and it's going to choose its convenience value V. So it has to design the CBDC. And then each agent already has an account with the commercial bank, for starters, although that ultimately becomes endogenous. So each agent then is endowed with a project, and there's a relationship banking assumption, so you have to go to, you go to your bank. and you seek to borrow. And the project that you're endowed with, that's a draw from it. The quality of that project, so the probability of success is a draw from a distribution, so independent draw. So projects pay A, but you get certain probability of realizing that return. And so the agent goes to their bank and seeks to withdraw, and then the bank decides whether or not it wants to lend to a project of that particular quality or not. And if the loan is granted, then the entrepreneur pays a worker, which is just another agent, $1 to carry out the project, and then that worker has to decide where to deposit that dollar, okay? Because the money stays in the system, and then all the projects are realized. So this is where the differences in the bank size is going to come into play. So one thing is that we model heterogeneous banks, but then the other thing that's, I think, pretty interesting is that we explicitly model the deposit creation. Okay, so the idea is that if we think about what happens when a loan is created, right? I just started off with a simple idea of having a narrow bank, and then when the bank wants to make a loan, okay, it does that by creating a deposit. So the bank issues a loan and it issues a deposit on the asset side and the liability side. Okay, and so that's what happens first. So the entrepreneur says, I want to borrow $1. The loan says, okay, you're a good risk. I'll issue that loan and I'll generate that deposit. But then what happens, right? The deposit doesn't just sit there. The entrepreneur has to go out and spend the money that they borrowed to build the factory or whatever it is they need to carry out the project. In the context of the simple model, they have to pay the worker. Well, that worker is going to do what with the deposit? Okay, deposits have to stay within the banking system. So that worker is going to deposit that money somewhere, and there's a chance that they're going to deposit it in the same bank. If they deposit it in the same bank, then part of the deposit that's created from that loan is retained. Okay, and this probability. So what happens in what the ultimate change in the balance sheet is for the bank that makes the loan is that their reserves, they don't go down by X. So XS is the probability. We just thinking about this in expectation. These are expected reserves, say, or what it would be on with many loans. They're only going to lose alpha S. That's the fraction of workers who deposit in the small bank, and they're going to retain a fraction alpha L. So alpha S plus alpha L is equal to 1. And this is just representing the idea that a fraction of the deposits are retained by the large bank. And more deposits are retained by the large bank than by the small bank, and that makes the opportunity cost of lending less for the large bank than for the small bank, and that's the key reason why you get differential impacts in the deposit and lending markets. Okay, so that feeds through. If we look at what the marginal profit is, this is just a simple calculation of the marginal profit of a single loan. It includes not only the profit on interest on reserves, the profit on the loan, and the cost of the deposits, factoring in this idea of retained deposits. If we compare that to what happens if they don't make the loan, we get this marginal profit from making the loan. Okay, and again, this is going to differ across the banks because it differs on the likelihood of retained deposits. Okay. Just to sort of convince you that this is a meaningful thing to incorporate in the model, what we're showing you here is the large bank concentration in the United States. So maybe just focus on Bank of America. So over 10% of deposits in the United States, which means that if Bank of America makes a loan, we could think, roughly speaking, that they have roughly a 10% chance of retaining that deposit. Okay, so not a negligible feature, I think, to be including in the model. Okay. I'll go quickly through the equilibrium, but basically we have to sort of go, solve it backwards. And so we have the deposit market at T2. So this is where depositors are going to choose where to go. Okay. So once the interest rate are known and the convenience value is known, they're going to choose where to go. Essentially, remember, they're getting this draw from some distribution G. So some fraction of the consumers will have a delta that's lower than the interest rate spread. So this is positive. RS is greater than L plus the convenience. Those people are going to go to the small bank. The rest of the people are going to go to the large bank. So this came up earlier, but this is the endogenous choice of where depositors go based on the what they make in terms of interest and what they get in terms of convenience across the two banks. So that's an endogenous choice. Then in the loan market, once we can factor in what the depositor choices will be, we can use that to figure out what the opportunity cost is of a loan for these banks. And so that's where we get these thresholds, which we call Q. So remember, QI is the probability of success for a project. So each bank gets a particular threshold. So it'll make loans to any project that has a probability higher than the threshold. So we get these bank lending thresholds. They also differ across the two banks. And then lastly, we have the choice of the actual deposit rate. So then we have to feed everything in. This is a more complicated expression, but now, of course, we're just integrating over all the loans that the bank chooses to make, all the QIs that are greater than Q star for the large bank. And so integrating over those, we get the overall profit from loans and the profit from reserves. Okay. So they maximize that profit function. And that's where all the algebra comes into play. And then what do you end up with? You end up with two cases of equilibria. You end up with unconstrained equilibria, and really these equilibria depend on how high F is, how high the level of IOR is, interest on reserves. And essentially what happens is that for low levels of interest on reserves, you end up with a constrained equilibria. So when interest rates are very low, because of the competitive advantage the large banks have due to the convenience it offers, it would like to charge a negative interest rate. Okay, but we don't allow it to. It charges a zero interest rate. So for low values of IOER, the large bank is constrained at zero. So it charges zero, and the small bank charges a positive interest rate, or offers a positive deposit rate. And then as IOER rises, the small bank raises its interest rate slowly, but the large banks are still constrained, so they continue to offer zero. And then when interest on reserves gets high enough, we move to an unconstrained equilibria, where both banks start to raise their rates. Okay, we have an interior solution. And it turns out that this is quite interesting, because this helps to really understand, I think, interest rate behavior, deposit interest rate behavior in the US. So yeah, there's a, what else do I want to say? Yeah, so I think I'll skip that. That's just summarizing things I've already said, but I'll just go straight to this picture. So I've broken down sort of deposit rate history in the United States into two periods, before the crisis and after the crisis, the financial crisis. We've got lots of crises now. And so the idea is that before the financial crisis, interest rates, IOER was high enough that we were essentially in an unconstrained solution, which means that as we vary interest on reserves, both deposit rates at the large banks and small banks adjust freely and move essentially one-to-one with changes in interest on reserves. So what we see here is we're seeing the red line is the blue line is the actual deposit rates, and the red line is the predicted deposit rates by the model. And so they move more or less together. And then what happens when we move to post-crisis? Okay? Post-crisis, what we see is that, well, interest rates were essentially zero for quite a long time. But then we had in December of 2015, we had liftoff, and the Fed started raising interest on reserves, raising. Deposit rates don't come up. Okay, Powell was asked about this. He said there's a lag. But essentially, we get very little responsiveness to changes in interest on reserves when interest on reserves is low. And what we're arguing is that's because in this region, the large banks are constrained. They're in the constrained equilibrium. They're stuck at zero. They don't really need to raise their rates. We get some action because the small banks raise their rates, but until the large banks raise their rates, we don't get movements that are anywhere near commensurate with the changes in IOER. So we think this model, looking at the heterogeneity of banks and the different responsiveness of interest on reserves policy across large versus small banks, is key in understanding deposit rate movements. And so that's an aspect of the model that we think is important, independent of the CBDC analysis. Sure.
One clarification, you think about before 2008 as the patent rate, interest on reserves was zero, right?
Yeah, so, okay, I'll just clarify that. Yeah, so when I say, I should have clarified that. It's the policy rate. It's really the federal funds rate that matters. Yeah, and so what we're actually tracking here is this is the effective federal funds rate, that's right. And then in the second half, that's what should determine the movements, and that's the policy. And then in the second half, that essentially becomes interest on reserves. Yeah, good point. Okay, all right. So now I can just get into some of the punchlines. And so, what's the impact of the CBDC? So really, what I'm just going to show you again the pictures for the uniform case, but the paper is more general. But all I'm also going to do now is I'm really just going to sort of show you pictures of those bullet points that I gave at the very beginning. And so this is a simple picture of what happens in the deposit market. So we're considering in this case a situation where we're going to raise S. We're going to raise the interest on that the CBDC is offering, and we're going to ask what's the impact on the deposit market. All right. And by the way, we're looking at the constrained equilibrium here, because in the unconstrained equilibrium it means that S isn't binding, so movements in S are irrelevant. But once S becomes binding, what happens, it's going to cause the large bank rate to move 1 for 1, because S is now a binding lower bound on the deposit rate at the large bank. So that moves 1 for 1. Okay, whereas this is an equilibrium response of the small bank, which is less. And so what we end up getting is that as we increase the CBDC interest rate S, okay, which is bringing deposit rates closer and closer to IOER, that's sort of like the objective, it's because of the different responsivenesses of the two banks, we get a divergence in market shares. So because the large banks, it offers more convenience generally, and it's offering a higher and higher interest rate, we get an increase in the share of depositors at the large bank and a decrease in the share of depositors at the small bank. In fact, you could put the small banks out of business. All right, and that translates into the lending market. That, of course, translates. So we're raising the quality of the large banks. Both loan quality thresholds are increasing because we're increasing the opportunity cost of making loans at both banks. But because the large banks' market share is increasing, and because we have this relationship lending, so lenders have to go to their bank, we get an increase in the loan share for the large bank as well. Okay, so yeah.
Am I understanding correctly that the black line on the right says that the total lending is
decreasing?
Slightly decreasing?
Yes. Yeah, and that's in the uniform case. No, it can go either direction in general. Yeah. Okay, and so the impact of the CBDC interest rate, yes, S, so it can raise deposit rates. So that's essentially the objective, but it can ultimately lead to the entire deposit and loan market going to the large bank. It doesn't have to go that far, but it's going to lead to a divergence of market shares. So in contrast with the CBDC, with convenience, we get a much different picture. So again, think about the idea of a convenient CBDC. So we have this idea that convenience is leveling the playing field, right? So this is just a way to think about about what's driving the results. So in the constrained equilibrium, we have the idea that the small bank can start lowering its deposit rate as the CBDC as the convenience level offered by the CBDC increases. That makes the small bank more attractive relative to the large bank, and so the small bank can compete with lower interest rates. So the small bank is lowering its interest rates. Meanwhile, the large bank is still in the constrained solution. So it would be raising its interest rates, but it still hasn't reached the lower bound. And so eventually, it starts to raise its interest rates. And when it does that, we actually get an increase in the overall deposit rate. So for high enough levels of convenience, we start getting this increase in the deposit rates resulting from increased convenience. Meanwhile, throughout the process, we're getting a convergence of market shares instead of a divergence. Okay? And then we get similar things that are happening. Yeah.
So the total amount of deposit, what is that going to?
That's fixed. That's fixed. But the allocation is endogenous. Yeah. The allocation of those deposits. Yeah.
But the total amount of DeFi is fixed.
That's right. That's right. So the key is that with the CBDC, when we think about the impacts of convenience value, the small bank can lower the deposit rate. The large bank eventually has to start raising its rate. And so eventually we get an increase in the overall deposit rates, which is the goal. But we also get this while having a convergence of market shares in both the deposit market and the lending market. Okay. Okay. So I'll conclude there. So the one result I didn't show you formally is this result I mentioned about the cross partials, about how in the case of interest rate policy, raising the interest rate sort of makes IOER or deposit rates less sensitive to IOER, whereas increasing convenience makes deposit rates more sensitive to increases in IOER. So that's the additional feature. But instead just focusing on these basic ideas that either interest rates or convenience can be used to increase pass-through. Increasing the CBDC interest rate raises deposit rates, but it causes a divergence of shares. So this basically happens because increasing the CBD interest rate essentially reduces competition, whereas increasing the convenience value will raise deposit rates while at the same time causing market shares to converge because it effectively increases competition. Okay, that's it.
Okay. Thank you so much for the invitation to discuss this very interesting paper. So, as you saw, the main question of this paper is, as we are now at the point where central banks are kind of facing the challenge of introducing some digital currency, how should we design it, right? And there's a lot of research, theoretical research already happening, and there are several concerns that this literature already, solved or settled on, and some points that you're raising or implementing in the model, and some new points that you have in the model. So somehow you start with this, it's a fact. Somehow, sooner or later, if we want to have a saying in public money in a digital economy, we must somehow provide a product that actually offers this access. But then, something that is very important is how should we design that? So what's the driving important things that we want to have for such a digital currency? And in the early literature that you already summarized, on one of the slides, there was this financial stability implications, concerns, which are serious, but to some extent, so the concern is that the digital currency would crowd out the bank's business, basically, impair financial stability, and reduce lending to the economy. I know several very good papers on that. But to some extent, the solution would be, backing the currency with the central bank, so CBDC in itself, and allowing the banks to distribute it. And that's so everything that's blue here, that's in the model. So, right, so that's what is captured in the model. A new point or a new question that this paper raises is what's about this market structure? What are the implications if you have heterogeneous banks with huge market shares for the large banks and very small banks? So the finding here of this paper is that basically a CBDC would foster competition, which is a good thing in this model, leveling the playing field, and if we allow for higher remuneration on the CBDC, this would force banks to increase deposit rates, right? So somehow we set the lower bound from 0 to CBDC level. And we also have some monetary policy implications, which highly depend on the design features, as we have seen already in the presentation, and not only on the remuneration, but also on how much depositors actually value this digital currency, which then entrenches this zero lower bound or the new lower bound on in the policy rate. So very clean, elegant, intuitive model with an interesting question and robust findings. But some things in the model we have also already seen in the discussion here in the room, the reader stumbles over. So I give some questions and some suggestions how to maybe smooth those out. The first thing I stumbled over, and this was not yet discussed here in the room, is for me it feels a bit like there's a difference between the story that you're telling and what I then find in the model. So the story is basically, well, these banks have excess reserves and legacy deposits, and then they have, whenever they make a new deposit or whenever they give a loan out, they have to face or they have the fear that this is not coming back as a deposit to their own bank. And the smaller their market share, the bigger is this fear, which makes them then less competitive and entrenches them in their inferior market position. But if I write this down in a model, this would mean that basically my profit as a bank comes from the lending return, the legacy deposits that I have, and then I have this fear of the new loans that I do, if they come back with this probability or not to my own bank. But then when I look into the model, this is actually different. What I see is the lending return, and then there's also the legacy deposits that are somehow floating out or coming back. It's not only the new deposits, it's also the old deposits. So somehow I think in the steady state, or is it, maybe I made a mistake, maybe I misread that, but this is from your model, and this is what I thought the equation should look like. Because at least I think in the dynamic setting, in the steady state, you need that, but then I would want to have a better story or a better explanation, because I felt like this is a mismatch between what you say and what's happening. The second point that was already discussed a lot here in the room, that's something you stumble over, is this idea, okay, there's this convenience value that you get from using the digital currency, but then you stumble a bit over the fact that basically in equilibrium, everyone holds their own bank deposits, at least at the small banks. So you're not really using the digital currency, but because the bank has access to it, it can offer a higher convenience yield. So that's a bit surprising in the first place. I think while reading your paper, and you explained it very well, I think I understand that. I mean, I could imagine a lot of setups where this could be true, especially when you think of that such an app, as you mentioned it here in the presentation, could offer you more convenience because it's more accepted. You can use it for different things. So by using the digital currency for transactions, you can still keep your deposit in the bank, but then you're using, basically it's a savings and transactions account, just that the transaction account is somehow directly linked to the central bank. This I would like to see a bit better explained, and I think then the story goes smoother, a bit better to digest. And the third thing, well, I think it's a very American perspective paper, which is great and important. As a European, I have a bit other concerns, and I think banks are a bit different animals in the US and in Europe, in the way that what we see is they are important for. As you mentioned, in the US, their main importance and also the pass-through of monetary policy comes from the deposit side. In Europe, where we have small, medium-sized firms being much more reliant on the bank, we are always more concerned on the asset side of the banks. And we have also, I mean, not anymore, but we have been concerned in Europe a lot about negative policy rates. And we have seen that during these times of unprecedented monetary policy, that banks with high excess reserves were actually the ones suffering most because they had struggled to, what to use their reserves for. So basically the large banks would have a disadvantage in a negative policy setting, also in your model, because they are attracting more reserves instead of getting rid of them. Right? Of course, this is a very particular setup, not even so much important anymore as we are all facing inflation. But I was wondering how that would work then in the model, basically a bit in the opposite direction. And also something that you are probably for good reason very silent about is the objective function here of the central bank. What is actually the goal of the central bank? How does the optimal mix of convenience yield and interest rate that you pay on the digital currency depend on what actually the central bank wants and does, right? And also you said that the monetary policy transmission happens through the deposit rates, but then the deposits, as the question already asked, the overall amount of deposits is fixed. So basically you don't have really monetary transmission because they just go from one bank to the other, but you don't have so much new deposits that are, so you cannot convince savers to save more, basically, right? But that's no problem. But then I was wondering, by reading your paper, what is the ultimate goal of the central bank? I mean, we know that actually we give them already too many goals, right? So they should be concerned with monetary transmission, but then since 2007, 2008, they are also concerned with financial stability, which might be a very big concern still when designing the CBDC. And here in the model, you're also looking at welfare increase. So at some point, we have to think about what is actually the goal, what is the ultimate goal that the central bank introduces this digital currency. And then something, and I think this is my European perspective, when you think of deposit rates and raising them, there's a lot of literature on that this is basically not necessarily good, because it depends on how the banks are able to pass this raise in the depositor through to their loans and to the quality of the borrowers. So my question here is, what about the risk-taking of the banks? What's the ultimate stability of the bank in their lending decisions? So if high-quality borrowers are actually scarce, they might drop out if I ask too high of the loan rates. And if you introduce other frictions, such as moral hazards on the borrower's side, then raising the loan rates because of higher CBDC remuneration would actually fire back, because you might get a worse, the pool quality of borrowers that you're facing might become worse due to the higher funding costs. Also, when you think of financial fragility in the terms of runs and bank runs, then usually we know, at least from the theory, that if you ask for a higher short-term rate without actually also being able to offer a higher long-term rate, then this increases the probability of a financial run on the uninsured deposits. This is also the fact that I think Agnese Leonello, Tony Arnott have a paper on that, how CBDC would actually destabilize banks by introducing a higher remuneration. And then very tiny remarks just to wrap up. What I wondered was, why are deposits not remunerated until the depositors decide to change the banks? So the remuneration happens only in time 2, once I settled with the bank, but actually the legacy deposits are not getting anything in time 1. And then in your conclusion, you state that the CBDC impacts the equilibrium even if the currency is not held. Yes, that's true, but it is still necessary to be there, so it's used for transactions. So you make this parallel to another paper where you say, like, well, you have a efficiency increase because the CBDC is there, even though the people don't use it to store, to deposit their savings, but then they must at least use it for transactions, so it must be actively used, otherwise the convenience value might not be increasing. And, the last comment is just a gut feeling that I had for you to think about, that it would be interesting to see what if depositors had some, if borrowers had some market power, what would happen in this equilibrium. But I want to close here, and thank you very much.
Great. Well, thank you for those comments. So let me just respond, I guess, to a few of them. So I think in terms of the story of the equations, I do think the equations match the story, but I couldn't reconcile those two equations that you put up there instantly. But I'm pretty sure the equations do match the story. Then in terms of negative interest rate rolls and whether or not it's U.S.-centric, yeah, I think the paper is U.S.-centric. That's the idea. And if one wanted to consider the likelihood of an environment where negative interest rates were more viable, then that could be built into the model, but then other aspects of the model should be changed too, because this is my whole point, that the model needs to be tailored to the specific economy that you're interested in if you want to have meaningful predictions. I'll say a quick thing about optimal mix. We used to have a section in the paper about that, about the objective, and we took it out just because, I mean, the paper's already, you know, how much can you do? I mean, we're introducing this new model. We're introducing these features. We're modeling convenience for the first time. It's not easy, obviously. There's some debate, which I welcome. I mean, ultimately, it's worth spending more time arguing about the details of the model than anything else, because the results follow from the model. So that's fine. But let me talk about the one point mainly about this CBDC as a threat point, because that's a really important feature of this type of model. So a key feature of our model and other models that exist in the literature is that the banks have market power, which means that disintermediation is not immediate. Because if the banks have market power and are making monopoly profits, then they can respond to something like a CBDC by offering higher rates, and that's kind of the key idea. And the CBDC doesn't necessarily have to be used for that purpose. It just has to be there as a threat point. But the existence of the CBDC can still provide the convenience because the CBDC technology has been given to the banks. That's the convenience value aspect. So the idea is that people might largely hold their balances in terms of conventional deposits. They may, you know, in some cases where the convenience value of the bank is higher, they value the bank's app more. They'll also transact through that app, but they can also transact through the CBDC app when they find that convenient. So that's really the idea there. So yes, it is sort of a threat point in the sense that it ends up just forcing the banks to sort of give away some of their profits, which arguably might be a good thing. But it's still, but this is where the convenience value part becomes so important. The fact that you're providing this convenient CBDC, this app and technology, and possibly ATMs at post offices or however this gets implemented. That's an additional convenience feature that's there as well. And so it's true, this idea that we're saying you can seamlessly move the money across the accounts and use one as a store of value account and one as a transactional account. Yeah, that's in the model. You know, one can add frictions to that, one can change all of these things. But, you know, fundamentally, I think what's important is to capture this idea that there's differential impacts in the market. And that by increasing CBDC, we achieve this dual objective of raising of deposit rates. You know, in some sense, you know, there you're just giving consumers a larger share of that pie, while at the same time preserving market structure. And that's also related to the idea of financial stability. You know, one of the reasons why you don't want the small banks to become too small is because then they become too fragile. And so that's one of the reasons why a policy that doesn't create too much of a divergence in market shares is considered to be a good policy. So that is a financial stability argument. Yeah. So thank you for your comments.
Kind of following on my question and what Eva discussed in her discussion. So I see there are two dimensions of competition here between a large bank and small bank, and within a large bank between attracting deposits in regular deposits versus deposits in central bank currency. So what is the objective function of a bank here? Like how bank can choose to provide better bonds, legally acceptable services to central bank account and provide, you know, glorious services for regular checking account, or it can play with interest rates. Like what is the bank's objective function here? How banks chooses to between two types?
Thanks for that question. Yeah, so the bank's objective function was there on that slide. It was the third, when they choose deposit rates. So it was that big integral equation. So essentially the bank is maximizing profits. And the only tool that we give the banks in this model is their deposit rate policy. So in principle, they could also be changing the quality distribution that they're offering. We don't do that. So the bank's maximizing profit. It's responding to the introduction of a CBDC. It doesn't get to choose whether or not to offer the CBDC through its bank. That would be a government policy. So that if the CBDC gets launched, and it's launched with interest rate policy S and a convenience value V, then the central bank, or then the commercial bank responds by choosing an appropriate deposit rate. So again, if the central bank introduces a high interest rate, then if the bank wants to retain deposits, it's going to have to raise its deposit rate to compete, and that's how the model works. Yeah.
Okay, we can take one last question.
It's quick.
I think the model seems to rely a bit on the depositors are quite sprightly, and I mean, I've come from a British background, and we were discussing yesterday with one of your colleagues that depositors historically in my home country are quite lazy, and you're actually more likely to divorce your wife than to actually change bank in the lifetime. And so perhaps we're getting a bit more sprightly as we're getting into the newer generations, more tech savvy, but do you have a good empirical founding for this sprightliness? And just a comment, more detailed thing about the terminology, about large banks and small banks. It just seemed a bit biased towards the technological advancements of big banks. And I'm not sure that that's fully founded globally, because, I mean, in a European environment, it's often the small banks that are the most technologically advanced.
Yeah, so these are both good questions, and so the sprightliness of depositors is certainly important early on, but ultimately this solution becomes stationary, and so then the depositors can just stay put. But yeah, so I guess that's What was the second point?
It's about the big.
Oh yeah, sorry. Sorry. So you're right. We're using large bank here as really just a phrase for the bank that offers more services, that offers more convenience in its deposits, which one could argue is correlated with being large, but we don't endogenously through some sort of network effects model or something. We don't endogenously establish the large position, but given that we model the so-called large banks, I agree, maybe not the best term, as having this advantage in offering convenient deposits, then of course in equilibrium they do have larger deposit shares. Thank you.
Thanks. We hope you enjoyed the Riksbank session on payment innovations and financial stability. We would like to thank another time the presenters for the great presentations, and especially the discussants for preparing such great discussions. We hope to see you again in future Riksbank sessions. Thanks also to the audience for your great comments.